Good morning, everyone. I am Mohit Rakecha, and it's a pleasure to welcome you all to this budget special masterclass. I'm the Group Financial Controller of Venture Catalyst, an early stage investment platform on a mission to democratize angel investment as an asset class in India. Foundational to this is investor education and awareness, and today's masterclass is one small step in this pursuit. Joining us for today is a very distinguished professional, CA Eshank Shah, partner and head of startups, transactions, and funds vertical at Banchi Jain and Associates. If you've been reasonably long in the startup space, either as an investor or as a founder, any person who's sort of actively working in this space, chances are slim that you haven't met him, heard him speak, read his insights, or expert opinion sections. He is synonymous with everything tax and regulatory so far as startups and the world of funds are concerned. Ishank, we are so pleased to have you with us today.
Thank you, Mohit, for the warm welcome and to the entire VCATS family as well for putting this together. I think with the budget that happened on 23rd of July, a lot of questions have come in, a lot of things to clarify, things to better understand. And for startups particularly, it's been, I would say, the budget that we have been waiting for. So with that, I think there'll be a lot that we could share with the participants who are joining today, and they could use this going forward in their investment journey.
Thank you, Ishank. We are pleased to have you on board today. So the Union Budget 2024 may be a lot of things to different set of people, right? If you come from the world of startups and Indian entrepreneurship, whichever way you look, it's a definitive leap forward. It is reformist, forward-looking, and sets the bedrock for a greater contribution of startups and Indian entrepreneurs towards India's push of a $10 trillion economy. It will continue to ensure India remains a melting pot of talent, activity, and becomes the so-called promised land that we've been so far waiting for. Uh, we are going to uncover two very massive and headline issues that we've sort of been exposed to, but don't really understand the nuances of. First being the abolition of the angel tax, and the second being the long-term capital gain tax amendment and the reduction in the tax rates for unlisted investments from a 20% on a long term to a 12.5%. Both of these are very welcome changes. And in the course of the next 1 hour, we'll attempt at our end to try and uncover and decipher this for you, right? So let me begin with the angel tax discussion. Cause celebre. This is a term I was recently exposed to. It literally means any controversy that attracts great public attention. Cause celebre. In tax circles, if there was ever a case that fulfilled this and justified this term, it has to be the angel tax. A, a discussion, a matter that has drawn widespread interest, uproar, frustration, resentment, and its abolition is indeed a watershed moment for all Indian startups and the fraternity at large. Uh, this has was initiated way back in 2012 with the intention of being able to tackle unaccounted money. In 2016, when the government launched its Startup India movement, this is when people started seeing the unintended application of this provision to the world of startups and fundraising. The section has been applied to startups who have raised capital from investors for their nascent ideas. As the money was raised from angel investors, it was labeled as angel tax. The section over the years has undergone a lot of transformation. There have been a patchwork of amendments that have come clarifications, circulars, safe harbors, etc. Ishank at his end has been tracking this very closely right since its inception. And Ishank, we look forward to your dissemination and your insight in terms of how this plays out for the larger investor community in general.
All right. Yes. Thank you, Mohit. Thank you for that entire summarization. I think helps our audience get quickly up to pace as to what we are grappling with. And just at the outset, and because we just start interacting right at the beginning, how many of us feel that angel tax applies to the investor who's investing in the startup? How many of us feel so? If you could just quickly, very quickly, 5, 7, 10 seconds, say yes, it applies to the investor who's investing in the company. If you could use the chat box quickly. And I'm trying to just locate that. If any of you could quickly use the chat box to say that, yes, this applies to the investor who's investing.
You can use the Q&A box for this. We have a
Oh,
Q&A
the
box open, you
box.
can use.
Okay. Yes, yes. Okay.
Ishank, while the participants write in, I have gotten numerous queries from normal folks not exposed to the world of tax and regulations who've
Yes.
sort of asked me, okay, as an angel investor, does this mean that I am going to be exposed to some sort of a harassment, some sort of an inquiry from the income tax office, etc.? And it's, I'm sure, post this session, people will have a clearer insight in terms of how this actually plays out.
Okay. So great.
Hmm.
We have a good sample population already. I think more than 75% people think yes, it applies to the investor who's investing in the startup.
Hmm.
All right. So here's how we'll set things going for a better understanding. And what we'll typically refer to now as what was angel tax, not what is anymore angel tax. So this, first of all, does not apply to the investor. It applies to the startup or an Indian private limited company. So we'll widen our thought process, not restricted to a nascent company, but to any Indian private limited company that was seeking capital or raising capital from investors. So let's through an illustration understand this better rather than sort of academic tax tax language. So we'll request you to assume a company that has 1 lakh of capital, which is divided typically into 10,000 shares of rupees 10 each, usually held by founders in a company. This is how typical Indian companies first set up a private limited company. Now let's say this company or this startup goes on to raise an investment for a 1 crore amount at a 20% dilution, right?
Hmm.
So they wish to raise a crore at a 20% dilution, which results in a valuation of that enterprise to be 5 crore. Now, this is just back of the hand math. We'll not go into why it's worth 20% and why 5 crore, but let's say that was a commercial agreement between the investor and the founder that this was the fair value of this enterprise. Therefore, 5 crore is the value. Now that the startup needs 5 crore rupees and it needs to give 20% equity on a 10,000 rupees share capital base, it would issue 2,500 shares. So it's 2,500 divided by the 10,000 that already exist, and the 2,500 it will issue to the investor so that the capital comes into the company. So that's a 20% ownership, which was what was the commercial alignment. And this was now arriving at a price per share of 4,000. How did that happen? That simple 1 crore investment was now divided by the 2,500 shares to arrive at the 4,000 rupee price per share. Now,
Correct.
because this price is 4,000 and under corporate law, the company typically has a face value and then the rest of it is as premium, because it is restricted to issue only 2,500 shares because it has 20% and it has to do that at a 4,000 rupee price per share. So 10 rupee being the face value, typically 10 or 100 in some cases, securities premium would become 3,990. That's the delta, the difference, the premium that has been asked on a price per share over the 2,500 shares would make this a 1 crore investment that the investor would bring in, and out of which 99,75,000 was securities premium. So here's where everything now began to get a little dicey. The tax law in 2012, which Mohit alluded to, mentioned that this 99,75,000 rupee, which this company has received as securities premium, would be subject to tax. In in the hands of the company itself that has raised this money. Now, why is it? Because the income tax is of the opinion that the value at which this amount, which is 4,000 rupees per share, has been raised is not justified. This was their sort of a rebuttal to why the provision was there in the first place, and its misuse came from an history earlier to 2012, because of which it was implemented in the first place. Now, in order to justify this 4,000 rupee value per share, they subsequently made amendments and required the merchant banker to sort of provide a valuation report in order to justify the fair value of the shares being 4,000, and that value would have been derived only by a method called the discounted cash flow method. So there were a lot of restrictions that came in with this section being implemented, and certain processes to be very strictly followed in order for things to work. Now, because this excess of 99,75,000 was subject to tax, the tax rate was anywhere between 22 to 25%. So out of this 99,75,000, almost 22 to 25% would have to be shelved off for tax if we were unable to justify this fair value. So this is the entire premise as to what was happening. It was not affecting the investors. The investors were nowhere involved in this. They had invested in the company for a certain equity stake, for a certain investment amount at a certain value and a certain price per share. The company had to follow certain processes because that was the requirement of law. But what transpired from having implemented that law to July 2024 was something that was not foreseen. So what happened? Firstly, hundreds or thousands of these startups started receiving these tax notices that you have raised this premium of 99,75,000, and that we wish to further understand the valuation and the mechanism in which this value has been arrived. Who are these investors who have invested this money in your company? Why is it that your company is of this value? And you're required to provide proof of all of this information. Now that they have this information asked in the form of an income tax notice, startups started providing some of this information in the form of certified reports run by professionals who had done this exercise. For lack of understanding, a lot of companies were not so well aware of this process or were apprised of the specific requirements, and particularly the merchant banker report for an issue of shares at a certain value. What would happen if the price was not aligned with the value that was commercially agreed? These were very open-ended questions. However, they provided this information. The tax authorities further began to question that information which was provided, citing that this is not valid and that this is not correct, and they provided their own perception or calculation of the value of this startup. Now, this
Correct.
began to percolate throughout the ecosystem. Like I mentioned, hundreds and thousands of startups started getting these notices. Because the startups pressed for time, pressed for resources, pressed for access to the best counsel that could guide them as to what they would need, provided information that they could do in the best of their interests, which in some form and manner was not complete or not satisfactory. Orders got passed by the government authorities. They raised demands. The 99 lakh amount was raised into 30%, let's say 25%, sorry, as a tax demand, coupled with the penalty and an interest. This demand was formally raised to them because they would not have the resources to sort of pay for this. Their bank accounts were frozen, and there began a large hue and cry, maybe somewhere from 2017, 2018 onwards, because that saw the peak or the start of the startup activity ecosystem, which began to catch complete steam, and then through the COVID phase was continuously in demand for raising capital. So all of this happened. Government came in between in order to pacify some of these startups, to create some safe harbors, which Mohit mentioned, that if there are companies that would raise an up to 25 crore of amount and they were startups, this particular section would not apply, right? If they were investments through AIFs, then this particular section
Would not apply. Correct.
and in that context, they started creating some harbors. the section never intended to apply to non-residents to begin with. So NRIs were never part of this. They could come in at any valuation without being questioned from a tax point of view. There was therefore always a distinction between a domestic and a foreign investor. Domestic was more penalized as compared to a foreign. So somebody staying at home was more penalized than someone staying out, just because they were more accessible, right?
I think, Ishan, the presumption under law was the unaccounted money are largely from domestic pools of capital, etc. So that is what we intend to sort of curb. But of course, things changed last year, right?
Yes,
Hmm,
and then came the bulldozer to follow,
hmm,
is what we call in our world. They said,
hmm.
no, now the non-residents are out, will bring non-residents in as well. And they included non-residents as well. That created a lot of issue on the non-resident community. These are large institutional funds, sovereign wealth funds, who all invest from foreign, and they were not too pleased with this. So the government again created some more safe harbors for these non-residents, in terms of whom they are, where they are from, are they institutional in nature, what geographies they come from, and a slew of notifications, right? So if anybody would like to do any detailed understanding of any tax law in India, they should start with 56 to 7B in the past. It's a PhD in itself to know what would ultimately apply. Uh, and,
Correct.
and it was
Right.
Yes, and it was too much for any startup or an early company to absorb. And like I'm saying at the beginning, and which we all assumed, this was on the investor. Absolutely not. All of this was on the startup, a company that was either scaling or making an idea that was proposed to scale, finding out a market, category creation, employment generation, wealth creation. These were their goals, but they were slowly goalpost shifting to justifying tax authorities as to why they are so and so valued, at what price, giving them documents, justifying who's resident, who's non-resident, justifying that the money that they've spent through raising this capital has been used for the business, because the tax authorities went to question the application of this money that was raised. And hence this entire journey trans.
Correct. Yeah, yeah. So, Ishank, if I were to summarize this for our audience, the whatever you've just discussed thus far, essentially the issue was A, on startups raising capital at a premium, B, you raising it at a certain valuation, which the income tax thinks is overstated. There is a certain fair market value assessment that they have as per the rules that are prescribed under the income tax rules. So let's say the fair market value assessment in their eyes is 80. As a startup, you've been able to commercially negotiate a price of 100. The difference between the price that you were actually able to raise capital at vis-a-vis the 80 that income tax regards as a fair market value, that 20 was regarded as an income in the eyes of law, and the startup who raised that extra capital 20 had to suffer a 30% tax on that. Or of course, I mean, depending on the headline rate of taxation that the startup was attracting, had to suffer a tax on that, which essentially was a tax on the capital receipt itself, right?
Correct.
So that is in a nutshell the issue that sort of ensued because of this. And while the tax was not on the investor, it still deterred a lot of investment activity in startups from residents, and then last year from non-residents itself, because you are, as an investor, allocating capital for the startup to be able to do its market building activity, for it to be able to expand its team, be able to work on its product market fit, etc. And you see a 30% of that being expended to the government because of a certain view and certain provision existing in the Indian income tax statute.
Correct. And for our
Hmm,
audience as well as Mohit, we as
hmm,
professionals actually saw startups fail or fall or discontinue business because this happened in their journey. They were issued tax demand notices. They did not have the resources to pay the money, the demand that was raised. And in the Indian tax system, if you even wish to appeal against this demand, you're still required to deposit 20% of that demand amount in order to just contest this demand. And then there are processes to follow if you wish to sort of get relaxation on that. But coming back, companies that did not continue because this created a baggage on their diligence the subsequent investors were not comfortable with such a large tax demand lying in the books of the company, or the fact that their investment would be used to make good some of this demand just so that we could make an appeal. And while the startup was still discovering its market and its place. So a lot of startups in actual practice failed or shut down because of this section. Their bank accounts were frozen in some cases, so they could not make business payments. That led to their failures. That led to sort of liability claims on them. And this actually happened. While it may be a smaller population, it's still the population that got impacted due to this regulation. So with that came budget 2024, right? With the third term, this was the number one ask. Prior to the budget, there was a lot of lobbying with the DPIIT and the Finance Ministry. The DPIIT is the industry body that sort of represents startups as well as MSMEs to the ministries at large. And they made a strong push of abolishing this section altogether, citing reasons of the legislative intent of this section itself not being received, right? Of not being achieved, sorry. Because there was no credible proof that over last 10 years, by the application of this section, was any black money that was otherwise routed, was it actually discovered by the application of this law? There existed no credible, history to that. And with that persuasion, in the budget of July 2024, this section is now completely removed. Right?
Yeah, and also Ishan, it's a function of there being other remedies available under the income tax statute for the government to be able to tackle that, right? Which I believe you will be covering subsequently, right? High share premium can purely be a function of legitimate business decision, and it does not purely by itself indicate unaccounted funds, right? That I think that's where the gap was, and which is why it was based on a very flawed premise to begin with, right? And we are glad that the government's finally sort of come around and seen this and like made it like too good to be true kind of an event today.
Right. And with the abolishment, I think, yes, first of all, the breather that all founders, startups, and investors have is that they're not going to get to commercial decision-making questioning, which is you have a valuation for a company, the valuation is accepted by the counterparty, and that is also a global practice. Just to take one step back, while India is the third largest startup destination in the world, US and China being number 1 and 2, and India hopefully taking up those places soon. There are practices in those geographies that are not of this kind. There's a simpler kind which we are now going to follow. If there's a commercial alignment between company and investors, they raise the capital at that value, higher, lower, lesser than before, higher than before. None of these matrices now matter. And that's the breather and a global, I would say, benchmark that we have now drawn to be, if we are in top 3, to follow top 3 practices. But there is like our like our tax system says, some things follow on, they're not always finished. So does it mean that with this section abolished, everything is fine and there's no more questions and no more things to be undertaken? Well, that's not the case. There is still need to, from an Indian ecosystem point of view, be able to understand that whatever is happening, while it is in the interest of economic progress, also happens in the right manner. So there is a section 68 first of the Income Tax Act. And here would be the questions coming from our attendees and investors. You would all also been in receipt of certain notices, particularly in companies where you had directly invested, right? You would have all got such tax notices asking from you information about your investment in a particular company. And then further asking from the investor a copy of their bank statement or a copy of their ITR or a copy of their sources of income that enabled them to undertake such an investment in the Indian private limited company. So will this continue? That's an absolute yes. This will continue. Section 68, which is to verify whether the money that is credited, that is received in the books of the startups, has been received from legitimate sources or from people who have sources of income that enable such investments. And therefore, as investors, you will need to keep a record about these investments that you undertake, the copy of their share certificates, and these are particularly for direct investments only. A copy of your bank statements where you would have typically made this investment, and a copy of your ITR that sort of highlights your income sources that enables you to make investments. Right. So that is, first of all, the requirement that is going to continue. But Mohit, your views on two things. While at VCATs, again, this happened in the past. There was a lot of help that at Venture Catalyst was provided to investors to do some sort of response, and B, how AIFs are exempt from this.
Yeah, so Ishank, while there's this whole controversy surrounding direct investments from investors onto the cap table of startups, etc., the AIFs fortunately were exempted, right? So a lot of our angels who today, through our angel fund, invest into startups didn't have to really go through any of this. The angel fund itself was also exempted. And of course, at the time of onboarding these investors, there are certain KYCs because we're a SEBI regulated fund, etc., that we sort of stick to, adhere to, and ensure like we are fully compliant and on the right side of law, right? So, therefore, the investors who've been attached with us through our angel fund platform, etc., which is again been around for 4 years now, close to 4 years, they were largely insulated from this, right? Right. So for a lot of them, all of this is like a first time understanding about, okay, there were notices like this received from startups. But we did have a few cases of investors who would have directly put investments in startups, etc. And by virtue of that, they would have been served notices under Section 133, asking them to furnish details, etc., about their investments, and that would further be used for by them to corroborate certain information that the startup would have furnished, etc., right, to cross validate, etc. In those cases, what we had done at our end was prepared a standardized set of responses for these investors, QA such investments that were facilitated by us. And then, of course, these investors were free to build on that response by consulting their tax advisor, their chartered accountant, etc., of preference, and respond appropriately to the income tax office, right? So a lot of those cases, by virtue of these responses, were sort of dealt with in a very delicate but in a satisfactory manner, and therefore we were able to sort of navigate that part of the whole trouble that the investors would have otherwise seen on their investments.
Right.
Hmm.
And even on the gift city piece, there too, there is the same protection, right?
Correct. So we at Venture Catalyst are operating a SEBI registered angel fund, which a lot of our resident investors are onboarded onto. The other fund that, and we are again the first in India to have launched one, is in the Gift City, which is predominantly to cater to our overseas investors and to our domestic investors who would want to, let's say, get access to certain overseas deals. Now, last year, Section 68 amendment covered only domestic funds, and there was this whole controversy, okay, whether gift IFSC funds are covered, etc. I thought that was just sort of a miss at the legislature's end, which has been duly corrected in this year's budget. So now both our domestic angel fund as well as our gift angel fund and the investors onboarded thereon are insulated from the application of a Section 68 and an application of a 56 to 10.
Got it.
56 to 7B, sorry.
Yes. So I think
Hmm.
the summary is for all angels investing through AIFs or regulated invest vehicles. Again, so is it all okay for you? Absolutely, it's all okay for you because you're going through vehicles which are regulated, and those vehicles are within the tax and regulatory framework, and therefore they do not need to again justify these sources of investments because they are all legitimate sources coming in from KYC verified investors, right? But for family offices or larger strategic investors who are still keen to directly invest on the cap table of the startup, a professional advice would be that you would still be subject to receiving of a notice that would enable the tax authorities to verify your information of investing in a particular company And typically this information will be requested directly by the startup from you, because the income tax asks the startups to provide the information about their source. So while it's cumbersome in nature, and lot of sensitive information which otherwise is not a preference for disclosure, due to this process gets disclosed, there is this 133(6) section which allows the startup to tell the income tax that you may directly seek it from the investor themselves. And that is why all family offices or strategics or private limited balance sheet investors will still bear a little bit of justification, and therefore need to keep that paperwork in place. Right? And there is a last or a smaller nuance on whether valuation reports would continue, because we were mentioning that the 56 to 7B requirement was of a valuation report from a merchant banker, which is now deleted in itself. The entire section is out, and therefore this is also out. Would still a report be required to identify what was the valuation of the startup? So the answer to that was, under corporate law, is yes. The company law follows a private placement approach, and therefore you need a report there. If you did a rights issue, you don't need to do it. And there are some nuances around that, but a generic answer would be still yes under a corporate law. And under income tax, there's another section that deals with receiving assets. Now, whether it will apply to an issue of shares, right? This is subject matter of more judicial interpretation. This is also new and not fully tested. So we have some more fingers crossed over there, but a safety net would be to still obtain a valuation report for the purpose of corporate and income tax law, just to make sure that the value at which we invested was received assets was fair and correct. And that will not be subject matter of too much question, but it is more to be hygienic about what had happened in the investment fundraise process. And
Correct.
that could be taken from any chartered accountant or an accountant / MB. So merchant banker, you could do any of those options.
Yeah. Ishan, just on that, I think there are more cases in favor of taxpayers than against, on the fact that a 56 to 10 should not apply on issuance of shares, etc. So I
Correct.
think taxpayers can sort of uh, get comfort from that, at least thus as things stand today.
Correct.
Yes. And Ishank, just generally, I feel like what has also happened, and this is slightly macro, was, if you remember, and you covered it at the beginning of your session, 56 to 7B never applied to listed, right? So again, the presumption was that these are companies that are already having transparency norms, etc., in place, such as identification of UBOs, mandatory DMAT, etc. Now, if you see the trend in terms of the last 4 or 5 years, what has happened is this transparency gap between a listed company and the unlisted has significantly bridged down. Whether it's mandatory dematting of shares, whether it's mandatory reporting of all security issuance under the SFT 61A, etc., whether it's the investors having to disclose their investments of unlisted securities in their ITRs, whether it's the mandatory filing of the significant beneficial ownership under the Companies Act that a private limited company is supposed to do, whether it's the requirement of PAN for investing in a company, etc., right? So these measures have sought to increase the transparency in ownership of private companies as against their listed counterparts, etc. So that again may have been uh, in the government's radar, in the government's thinking tank, and probably may have prompted, okay, now is the time for us to sort of be able to tackle this unaccounted money menace through other means rather than really troubling legitimate transactions, etc., and legitimate investment activity.
Correct, Mohit. And that's the whole thing. I think the thought process began with bringing parity of unlisted to listed, not strictly from a very high governance standpoint, but from a simple building blocks standpoint, right? And therefore, this budget, a lot of theme that we sort of thought initially as to what we could think about what this budget meant was, I think and with the last 3-4 years sort of improvement, we thought of this as now the building block to bring the unlisted or startup community to best practices that some of our larger and more better organizations follow. And I think with that came the ultimate second benefit, right? The parity came through not in one shot, but in two shots. which was the capital gains tax rate equality or equalization / rationalization. So this was also asked for budgets and budgets continuing till today. What you see is current and proposed. Current meant the pre-budget system, and it meant, and you see on column 1 and 2 is meant for residents between current and proposed, and non-residents. And POH basically refers to a period of holding that would help you understand what was short-term, long-term, and the type of assets that would be included, what would be their rates, what would be their holding, and what would be the rates in those holdings. And this is the first slide is still only restricted to long-term capital gains tax, and the short-term follows after this. We'll only spend 30 seconds on the one that's gone by, where you typically, as unlisted equity investors or investors in startups or investors in units of an AIF, would be subject to a long-term capital gains tax at the rate of 20%, with a period of holding of 24 months, typically in the equity or preference / CCPS shares. And this was the highlighted section that would typically follow. A lot of you would also be in listed investments where you'll still be more familiar and far more easier. But the unlisted one was 20% with a 24-month holding and an indexation benefit. Now, about 30 seconds on what is indexation, because I think a lot of us are not apprised of the same. Mohit, would you like to just explain on just indexation in general as a concept?
So indexation as a concept, Ishank, was predominantly for the lawmakers recognizing the fact that there is a certain inflation adjustment that they need to provide for on the original cost that an investor would have sort of spent or incurred as a part of the investment, right? So if I bought a residential house way back in 2002 and I am disposing it off in 2022, of course, there is a capital appreciation I have seen, and there is a certain sale consideration. But there is a certain inflation adjustment also that needs to be factored as a part of the cost of that asset that was acquired in 2002. And it's only the real gains adjusted for inflation that needs to be offered to tax.
Right. So I think this was an artificial increase in cost, right? It never appeared in anybody's book. So you could not go back to your finance team and say, please give me a higher cost in my books. This never happened. You would just do a tax calculation, and doing that calculation, you would artificially increase the cost by an inflation index that also
Correct.
the government would publish every year. And this allowed you to reduce your gain, but pay tax at a higher rate, which is 20%. This indexation is also now completely removed. So there exists no indexation and there exists no older rates. So what's the future from 23rd of July? It's 12.5% long-term capital gains tax rate, period of holding being 24 months. So wherever you're investing in companies, and let's say just take the example of the one that we did at the beginning, where all of you together as investors invested 1 crore, right, in our company here today, company X. And let's say that became 5 crore. 5 years or 4 years down the line, that 5 minus 1, 4 crore would be subject to 12.5% tax. So it's as simple as that for now. And going forward, if you invest this through an AIF, the calculation would still pretty much remain the same. 1 to 5, 4 crore, and the 4 crore would be subject to a 12.5% long-term capital gains tax. And that would be passed through to you in your individual capacity. The AIF investments continue to get the same nature as if you had directly invested in the company itself. So they do not in any way disadvantage you from a tax point of view, subject to any sort of carry, fee, etc. structures which the funds typically have. So with that, the entire sort of long-term capital gains indexation benefit is complete. There is a nuance between shares acquired prior to 2018, 1st Jan 2018, and shares which are acquired after 1st Jan 2018, and a nuance within that if they get ultimately listed. We do not wish to sort of cover that here, but just bring to your attention that if you happen to own some very good companies which were unlisted and you happen to own them prior to 2018, 1st Jan 2018, and they happen to get listed, please do seek some more advice. You still have an indexation benefit there. They did provide some sort of grandfathering, which is to just say that that's the portion we will not touch. We had promised you a benefit, we'll keep That's so. So we don't want to go too much into that because slightly complex, but pre-2018, post-2018, and whether it gets listed or sold unlisted, just do keep a nuance. If it's post-2018, you don't need to worry. You're in the new ship, as we say.
Correct, correct. So,
And
Ishank,
yeah,
Ishank, what the budget has done is it's brought parity on two fronts. A, residents and non-residents. Okay. So you had different rates of taxation for residents vis-a-vis non-residents, especially when it came to the unlisted asset class, etc. That has been done away with. The second that has happened is the parity between asset classes as such, which is, I mean, for the purpose of our discussion, let's say between unlisted shares and listed shares, and those have also been brought at par. It was a constant industry demand because what it was doing was these differential rates was creating non-market disincentives for investors. Investors would invariably prioritize a listed over an unlisted, etc., because there was a naturally a lower tax outgo at their end, right? This budget has sort of recognized this and has tried to tame this. Uh, between residents and non-residents, and we have a few. The residents who, let's say, through one interesting situation that came up recently, one of our investors called me and we were discussing this. The resident investors who has, let's say, an exposure in an overseas security through our gift fund, right, would also now be taxed at that 12.5% on the long-term gains, right? These are unlisted, so a 24-month period in an asset class, which is a more patient asset class like ours, we invariably tend to hold securities for a 3 to 4 year tenure. So most of them do qualify as long term. And therefore, that resident investor is now going to suffer a lower tax outgo, not just on domestic investments, but even overseas investments that they would have, let's say, undertaken either directly or through our gift angel fund. Right. So that was another interesting nuance that came up in the conversation and is like an impact of this budget amendment. And it clearly shows that there's a greater rupee capital appreciation impetus, reduced preference for listed equities and mutual funds over startups, at least so far as investors are concerned. So that's just one uh, takeaway for our audience.
yes, absolutely. The non-residents also becoming par at residents was also a very sort of a bold move in the sense that we've always, favored non-resident capital almost half the rate, right? Prior to this, 20%,
Correct.
they were at 10%. So we were giving a 50% discount to non-residents, which again, was was meant to incentivize foreign capital. But again, data showed a lot of capital moving now domestically rather than just overseas. And all of you may be also reading about such, growth in domestic capital into our Indian businesses. So that this parity is also now fully aligned and disparity, sorry, is fully completed. Short term, which is less than 24 months. So if you buy today, sell tomorrow, unlisted shares, you buy today, sell them in 12 months, 18 months, 19, 20, 21 months. These are all short term. And short term would mean there's no change. Unlisted securities would go into your slab rates that will be based on your personal tax profiles and accordingly get tax based on your personal tax profile. So it didn't change from the past as well. It was also the same before. It continues to be the same in future. So therefore, yeah, if you are anticipating sort of short-term capital gains on any unlisted investments that you're making, you should just also plan that the applicable rates would be based on slab rates. Right. So I think, yeah, a lot of it that we have covered. I think we are almost at 11:15. We wanted to keep some time for your questions. I believe they are more than our answers and presentations. And that's typical of any discussion on tax. But summary of all of it is, first of all, this budget is still to be tabled in the parliament. While we are at it, some more patience is requested from all of us. It has to just get notified. But there's no reason to now change any of this. These are all positive developments. I think it should go through. Indexation is going on a little bit back and forth. but let's see where it lands up. And we believe that this is a very strong building block to the entire ecosystem from here. From here, there are no more complaints we feel that are left, subject to smaller nuances and suggestions and updates which can happen from time to time. But what had to be set right is now set right. So you look at the journey from here on.